Welcome to MBT 5363. This is my 8th year teaching this course, and I'm excited to move this course online as we've been leveraging the wonderful technology of the Carlson School of Management since day one. My name is Keith Clark. You can see my contact information below. You can also use my University of Minnesota email address. However, I don't check that as frequently as I check my business address. You'll find if you contact me at my email listed here, the phone number, you'll get a rapid response. Quick background on me. I'm a University of Minnesota graduate. I've been in the qualified and non-qualified plan business since graduating from the University of Minnesota. I love this industry. Started my own firm, DWC Consultants, about 20 years ago. You can use our site as a wonderful resource, as everything we're discussing in this course is online on site under articles and insights. So the good news is you don't have to buy a book. You can simply go to the website for a lot of the stuff we're talking about over the course of the next 7 to 8 weeks. Okay, most of you probably interested in how do we score this online course. Well, it's pretty straightforward. It's the same as if we were on campus. I've been doing this for 8-9 years, and we've been using discussion boards from year one. When I received my master's, a vast majority of the work was performed on the discussion boards. I learned a lot from the discussion boards, mainly from my classmates more than my professor. The professor is leading the discussion, posing the questions, which is much the same way we're going to work here. So 35% of your grade is via the discussion board. Each week, I'll post a question or questions that we'll all respond to. It's normally fun stuff. It's not the traditional bookworm stuff where you read a chapter and answer questions. This is mainly about current events as it applies to this class. So it's a lot of fun. It can be opinionated. At the end of the day, all I ask is everyone have fun while posting. Make sure that there's no copying of articles or copying off of Wikipedia. Not a big fan of that. That'll guarantee a 0-point post. So how do we grade the weekly discussion board? Well, it's open each week from Thursday to Thursday, and you'll see that right on the board, and I'll show you that in a couple slides. For every post that you post during the week, I'll grade it. An excellent post, which is very rare, but you will see them, and you'll know when you read them, is worth 3 points. You could write a 5-page, 15-paragraph post. The most you're going to receive is 3 points. So that means you have to post it more than once a week. On average, I recommend posting 4 or 5 times during the week, starting early and being consistent throughout. A 0-point post is one that adds no value. If you just post a link or you just a super quick response to someone else that you agree or disagree, that's not going to get anyone anywhere. An average post is 1 point, and an above average post is 2 points. And those are the ones that are detailed and provide substantive information. Again, these are by week. So once the week closes out, that's your last chance to score for the week. And I do grade throughout the year, so you'll know when the discussion board closes what your grade is for the week. To achieve the total 35 points during the year in the discussion boards, we require 7 weeks and a score of 5 points each week. I just noticed I have a typo there. It's not 6, it's 5. So we'll change that to 5. Okay, and obviously the last item here is posting late and often in each week results in low scores. It's impossible to score the maximum weekly points if you just come in on the last day and write five posts to try to get your maximum points. It's really easy to see. Every year, if you do it in the first few weeks and realize it doesn't fly, because all of us can see that you post at 10 o'clock, 10:02, 10:05, 10:20, and 11 o'clock, and they're short and sweet. So again, I can't emphasize this enough. Post early and often. The rest of the scoring is the traditional midterm final. Good news for all of you is it's open book. It's very straightforward. If you listen in all the classes and gone and have participated in the discussion boards, it's pretty straightforward. Same with the final. Both the midterm and final will be released 1 week before it's due. And again, during the course of that week, if you have any questions, since we don't have an online class, all you have to do is call me or send me an email and I'll respond quickly. So how to post on the discussion board? It's very simple. Just go to our online class. go to the main page, and you'll see that we have the whole year broken out into 8 weeks. We'll be posting on the first 7 weeks. If you take a look at week 1, you'll see the lecture that you're listening to, so you know where to go. You already know where to go to listen to that because you're listening to this. Where I want you to go in for the discussion board is right here. We have it by week, and when you click that, it'll open into this chart, and here's your week 1 discussion board. I have a bunch of questions. You don't feel like you have to answer every question. I just went through all that a couple slides ago. The key, though, is that you put your reply here. It's important that you don't start a new discussion thread, which potentially can happen if you really know what you're doing here. But if you stay within this thread, it will not allow you to start a new one. Do not go to this one up here. This is no good. Remember, as you post, the earlier you post, the easier it is to score a 2 or 3 on each post. There's no need to copy someone else's, and if you are going to link in an article or copy and paste an article, that score is nothing. It should be supporting your current point or to add on to other points. But the bottom line, in order to score, is you've got to have original thought. And I do like links and reading other stuff, but think about it. If everyone in this class, if there's 20 of us, and all 20 of us are posting articles with 2 sentences, that takes a long time to read. So if you're going to link something in, make sure it is substantive. As you probably figured out with the syllabus and going on site, I'm not a big fan of the school books, paying the big money to have something sitting in your desk for 5 years or to resell it for half the money. I learned this the hard way that when I went to get my master's, I purchased a lot of money in books, and a lot of the teachers really weren't using much of the book. So here's the scoop. Everything is available on the internet or what I've posted here. You can also go to my firm's website, which has a fantastic articles and insights. Virtually everything we discuss in this class that you want additional answers to can be found on my firm's website. And that is www.dwcconsultants.com. You're all probably happy that we're not having classes on campus because my penmanship is not that strong on the chalkboard. Outside of the internet, make sure you can go to the IRS site or the Department of Labor site. They have fantastic information on all of our topics. Okay, here we go. Nice view of our wonderful building with grass that will probably be covered in snow by the time we end this session. This week we'll have part 1 and part 2. Then you'll go to the discussion board. So for the remainder of this class, this is going to be very high-level stuff, and then we're going to get right into it on the part 2 of this week. All right, here we go. Why benefit plans? Well, if you read the textbooks or the popular press, it's all the obvious. Attract the best and the brightest employees, set the culture tone for the company. And then, of course, it's the age-old. This goes all the way back to the defined benefit plans. Once the snowball starts rolling, all companies have to provide a certain level of benefits. You've got to compete with the other companies. So if I'm interviewing with 3 firms, I'm taking a look at my entire compensation and benefits package. What a lot of folks do is they just look right at the monetary portion. But if we look closely, a lot of firms have fantastic healthcare plans. Or if we talk about retirement plans, which is the vast majority of this course, there's some very lucrative plans out there. For example, my wife works at a Fortune 500 company that very rarely has a profit-sharing contribution of less than 10%, which is fantastic over 30 years. In fact, my firm's the same way. We've only had 1 year where we've had less than 10% in the last 5 years. So that's a wonderful benefit that a lot of folks don't consider when looking at other firms. Here's the interesting perspective of benefit plans. My firm, DWC Consultants, we provide the plan design, plan documents, and all this compliance work you're going to see about in the next 2 or 3 weeks for plan sponsors. Whether it's a small company, which we're going to call less than 100 folks, middle market, or large, the number one question we often hear when we're designing plans is, how can we best benefit the owners or the highly compensated employees? So again, the vast majority of the first 3-4 classes are going to talk about that. So if you think in the small plan side, owners are using the benefit plan, one, from a tax benefit to get the deduction, and two, a way for them to maximize their retirement goals. Obviously benefits the corporation twofold, one with the tax deduction, which isn't that big a deal as compared to the ability to attract the best and the brightest folks. For the remainder of the course, instead of using the word company, we're going to use the word that describes the 401k plan from the company's perspective. That is the plan sponsor. So when I say plan sponsor, that's the sponsor of the plan, which is the company. So now we're already starting to speak my language. By the end of this course, a lot of the words that we're using, such as highly compensated employee, top heavy, coverage testing, compensation ratio test, non-qualified plan, you're going to be writing and speaking language just like me, which basically accomplishes the goal of this elective course. Two goals I have with teaching this course are, one, first and foremost, is you walk away with a better understanding of qualified, non-qualified plans. You'll speak the same language I do in 7-8 weeks when you hear the terms top heavy, 415, 402G, highly compensated employee, family aggregation. Those will not be foreign words in the next 7 to 8 weeks. And my guess is you'll be able to apply a lot of this knowledge to your current client base. The second goal is, from your perspective, planning for retirement. And here's the building blocks all of us have, whether we're focused on a CEO or whether it's just we're an employee of a company. These are the components. It all starts with Social Security, regardless of the country you're in, as most countries have a basic Social Security plan. In the United States, we have defined contribution plans, which you'll read in the popular press, 401k, profit sharing, or ESOP. By the way, there's really no such thing as a 401k plan. It's a profit sharing plan of the 401k component, but that's a different story. Defined benefit plans. These are often referred in the popular press as pension plans. These are the what I call the old school plans that you think of the auto industry and a lot of the large corporations that they put in place back in the 70s. Non-qualified plans used 100% for executives. And that'll be a key portion of our last 3-4 weeks of the class. Then the other two components of retirement planning are your after-tax accounts, any real estate, house, just money you have in the bank, and IRAs. So all these components are the key to your retirement plan or any executive's keys to retirement plan. Let's discuss Social Security, a brief review of the cost benefits. Your cost is 6.2%. Your employer will match that 6.2%. So a total of 12.4 goes into the Social Security. Self-employed is obviously the entire 12.4. I threw in Medicare as well as an additional 2.9. It's the same percentage split as above 50-50. These amounts are only taken up to the Social Security wage base, which I'll show on a limitation slide coming up. In 2016, that limitation was $118,500. So if you make $150,000, you are only charged at 6.2% up to the $118,500. It's interesting to note that there is a defined contribution profit sharing formula. It's called integrated or Social Security wage base that allows the profit sharing formula to contribute more on a dollar or a percentage basis for those that make above the Social Security wage base as compared to those under. And that is a pretty common formula in large plans. Now we'll go more in depth down the road in week 3 and 4. The benefit of Social Security is not as easy to determine. Just try going to the Social Security website and using their calculator. There's 2 key variables that go into it. The first one is the calculation will take your top 35 years of earnings. And as I put in the parentheses here, defined benefit plans generally take the last 5 years of your employment, and those usually are your 5 highest years. So Social Security is your top 35 years of earnings. The other variable is the primary insurance rate, the PIA. And this is the monthly benefit rate at full retirement age, which, depending on when you're born, it's 67 now. I can assure most of you that in your 20s and 30s, it will not be 67 when you get there. It'll, if I had to guess, it's going to be anywhere from 69 to 71. From a selection perspective, as a recipient of Social Security, you can elect to start your benefit before that retirement age, which results in a lower monthly payment, or you can wait longer after full retirement age, which typically will result in a higher monthly payment. One key item to note is the spousal benefits. Generally, it's best to select at the full retirement age. Final note, Social Security monies are not held in a trust. So all these monies you're putting in are just going to a general treasury, a big pool of money. I shouldn't have said general treasury, because the treasury writes IOUs to the Social Security Trust Fund. So at the end of the day, the government's collecting the money and using it wherever they want right now. So you can read all these fun articles when Social Security is going to run out of money. At the end of the day, it all comes down to general taxes going to the government, and then the government has obligations, which one of them includes Social Security. Just for fun, for those of you that are interested in privatizing Social Security, because you're looking at this and say, hey, it's 12.4% of my compensation is going to the government. Boy, it sure be great if I had my own account. Well, let's assume you have a compensation of $70,000 a year, and if you're 25 years old, targeting a 67 targeting 67 years of age when you retire, if that old 12.4% goes in every year, starting now, you'll have 1.16 million in your own account. Adjust for inflation, that's about 439,000. So what you could purchase in an annuity may be far higher than what Social Security is going to pay you based on their benefit calculation. This is perhaps the most important slide of this presentation. It's the limitations related to defined contribution and defined benefit plans. Some of you may be aware of some of these, but most of these will be used in our next 3 to 4 classes, and it's a big component to your success in the midterm and final. So let's quickly review these. The annual compensation limitation indicates the maximum compensation you can use in a profit sharing formula or in relation to determining a deferral percentage for compliance tests. And we're going to see more of this in the next few slides. But to make this simple, in 2016, the maximum compensation one can consider for profit sharing is $265,000. So if everybody, let's make this simple, so everybody in the plan that's eligible to receive a profit sharing contribution gets 10%, it's 10% on the eligible compensation up to $265,000. So if you make $1 million, you're not getting 10% on $1 million, you're getting 10% on $265,000. The last 7 years on the midterm and final, 30% of you will miss that on the test. I'll put $1 million compensation, say if they get a 10% profit sharing, what's their profit sharing for that year equate to? 20% will put 10% times $1 million. It's the 10% times 265,000. I'm going to skip over the SEP stuff because that's on a later slide. Elected deferrals in the 401k. The most any one of us can put in a 401k plan or plans in 1 year is $18,000. If you happen to be over the age of 50 in that year, you qualify for an additional $6,000. So you can put up to $24,000. So if you work for 2 companies that have 401k plans, the maximum you can put in both plans is $24,000. So $12,000 in each or $24,000 one and zero. You can't put the maximum in both. That is a taxpayer limit. Skipping down to the 415 limitation for defined contribution plans, the most any one participant can benefit in the plan is $53,000 in a given year. So in 2016, the most you can receive in a company contributions, profit sharing, a company match, and salary deferral is $53,000. If you're over 50, that's obviously increased to $53,000 plus your $6,000 catch-up contribution. So if you're in multiple plans, if you work for 2 companies, you can receive up to $53,000 in both. You just cannot exceed the 18,000 elective deferral limitation. On the defined benefit plan, that is not a contribution amount per se. What the regulations indicate is that that's the maximum benefit a participant can receive in a defined benefit plan. And you can't exceed the lesser of the limitation in the year, which for 2016 is 210,000, or 100% of the participant's average compensation for his or her highest 3 consecutive calendar years. So bottom line is your benefit can't exceed that limitation. These testing limits, we're going to talk a lot about these in the next 2 sessions. This first one is HCE determination. HCE stands for highly compensated employee. And one of the criteria is if an eligible participant earns more than that figure in that year, they're considered a highly compensated employee. So if you earn more than, and I emphasize more than 120,000 in 2015, you'll be considered a highly compensated employee in 2016. I cannot emphasize this enough. It's more than, not the amount. Key employee, officer compensation, and key employee 1% over compensation. These are also more than. So if you're considered an officer in a plan, and just think about this as the big C's. If you make more than 170,000 in 2016, you're considered a key employee, and that's for the top-heavy test, which we're going to discuss in a second. Going back to HCE determination, highly compensated employee, that is for the ADP test. And this is all stuff that you're going to know inside and out in the next few weeks. In the week 2 classes, we have a whole session on defined benefit plans, but I want to highlight the difference between a defined benefit plan and a defined contribution plan. It falls into 2 key areas. First is control. A defined contribution plan, remember, is a 401k or profit sharing plan. Most of you in the class probably have the opportunity to participate in a defined contribution plan, where you can defer, again, up to 18,000 if you're over 50, 24,000. You may have a company match, you may have a profit sharing. So you control your destiny on the input. On the investment side of defined contribution, you also have the control because you're allowed to pick the investments. Now, it's not any investment. The plan sponsor is most likely selecting a menu for you to choose from. They may pick 10 to 20 mutual funds or ETFs, and you can select those. So you're in complete control of your destiny on the input from a deferral side and where you invest them. So if you're conservative by nature, you're probably not going to be aggressive on equity funds. If you're aggressive by nature, and obviously if you're young, you're going to probably have most of your monies in an equity fund. A defined benefit plan is controlled entirely by the company. They are setting the benefit, and they're also responsible for the funding. So an easy way to describe a defined benefit plan is they may provide 1% of your compensation for every year that you work for the company. So if you work for the company for 30 years, and again, I'm making this up, you'll get 1% for each of those 30 years. You'll get 30% of your final compensation. As I mentioned a few slides earlier, that final compensation is usually an average of the last 5 years. Again, very high level. So there's a promised benefit, you do nothing. As far as the investments, again, you do nothing. The funding is entirely on the company. And you have a couple articles that should be reading for week 1 and also be discussing on the discussion board. Is there are minimum requirements of what the company has to fund, because obviously you can't start a defined benefit plan, make all these promises, and not fund it. So there's minimum funding requirements as set by the government. In fact, most companies try to get to be as close to fully funded as possible, thus eliminating risk. You'll have plenty of examples will come up in the discussion board of companies that did a horrible job of funding and, quite frankly, was a key variable for that company going under because they couldn't keep up with the costs. So let's review real quick the difference between defined contribution and defined benefit plans. Defined contribution plans, you control everything. The company may add a profit sharing and company match contribution for you. Those are just added to your accounts. They may be subject to vesting, which I'm going to discuss on a different session. But at the end of the day, you control what you put in, what your benefit is, and how it's invested. A defined benefit plan, is simply a promise to you, the eligible participant, based on how long you work there and your compensation. It's obviously the lucrative ones, if exaggerating the point, if you're getting a 1.5% on every year you're with the company up to 30 years, I mean, that is a super nice benefit. Those are also very expensive, and that means the company has the funding risk. One of my favorite topics is the law of unintended consequences. In the case of plan design, the one thing we want to talk to plan sponsors when they're putting the plans in, are we achieving our objective? On the other hand, are we putting something in place that may have a negative impact down the road, which falls under this unintended consequences category? From a DC perspective, one that I've seen on quite a few occasions for the profit-sharing rich companies is folks will get to age 50 and they can retire. Well, if you think about it, by the time they get to age 50, we've got their best years. They've made all their errors. They're wonderful managers. They know what not to do. They know what to do. They can make decisions quicker, implement stuff faster, and be more profitable. You don't want to lose those folks. So that's one of the unintended consequences of those super rich defined contribution plans. From a defined benefit plan perspective, what I don't like is large companies can plan for government bailout, and you can read plenty of articles on those companies that may have had that strategies. But we're going to fall back to in defined benefit plans. They may very well have had the right idea going into it, and they just ran into issues, with the company and profitability. They weren't able to keep up the funding payments. And then when the company goes bankrupt, obviously the benefits aren't paid at the promises because they're only going to get paid out a smaller amount, which is dictated by the PBGC, which I'm going to talk about in the next slide. One of the other area is how defined benefit plans are treated in the financial statements. Underfunded is a liability. Overfunded inflates financials. Last slide for this session. The actual planning for retirement. I'm hoping all of you as individuals have had a chance to play with the retirement income calculator. If you're in a 401k plan, you probably have access to one. You'll get an annual statement that indicates if you're on your retirement goals from at least the segment of the 401k profit sharing plan. I ran these two calculations on the Vanguard site. The first variable was I'm 30 years old and I plan to retire at age 67. I make $60,000 a year, and you can see the difference in these two slides is how much I'm putting in, or combined with a profit sharing company match. And the slide on the left is 4,600, and the slide on the right is 10,000. And the other variable is what I've already saved. I'm at 130,000 on this slide and 65,000 here. My retirement income replacement ratio is 80%. I mean, some may put in 70, others will put in 90. 80 is a pretty good number to use. The earlier you are in retirement, the more you spend, obviously, and some folks buy big RVs or huge fishing boats. But nonetheless, you want to get to 80%. In this case, from a long-term planning perspective, I use an annualized return of 5%. I actually ran the basic Social Security calculator, so based on these variables, we're going to get $1,900 a month from Social Security. So in the example here, I'm falling short on my monthly income goals. So that means I've got to save more. On this one, I'm ahead. So I'm on a good pace here. So the bottom line from this slide is the more you put in now, the better off you are in retirement.